Hi, my name is Gabriel Cohen, and I will be talking about Abbott and Boston Scientific um, as part of my database research project for Accounting 311. These two companies are definitely two of the higher, bigger powerhouses in the med tech industry, and they're dominating with their products, devices, treatments, diagnoses, pretty much everything that is in that world. And yeah, let's start. Whoa. um, so starting off with Abbott, they've been around since 1888, good amount of time. They're headquartered in Chicago. They cover four broader segments of the med tech industry: pharmaceuticals, diagnostics such as COVID tests or at home other tests. They help with nutrition. Um, they made Pedialyte, fun fact, and other medical devices such as Freestyle Libre, which is a glucose monitor machine, and a couple others. In 2024, they hit over 40 billion in revenue, um, around 8% growth, um, given the fact that their devices and diagnostics are definitely doing well. Um, the other company is Boston Scientific. Um, they haven't been around as long, since 1979, but they are covering another good portion of the medical world, globally as well. So, um, med surge, rhythm and neuro pacemaker, and a couple others that cover different parts of the industry. So the both of these companies make products, they do treatments, and they do other things that help the world in a very positive way and are doing a great impact. Not as much revenue. Boston Scientific isn't as big, but it's going. It's moving along. It's growing for sure. Let's get into the ratios. To start, the liquidity ratios. So how much, if say they had debt to pay off tomorrow, how much of their assets or anything that they have could they liquidate to be able to pay that off? So Abbott is definitely a stronger company when it comes to paying off their debt. Not by much, but it's above one. They're both above one, so that's a good thing that they are able to pay off their debt. Quick ratio, Boston beats that pretty slightly. As far as short term, so they're able to get their cash quicker. Maybe hospitals and such pay them, faster. With cash debt coverage, they're the exact same. Not crazy differences here with liquidity, but um, here's kind of from the past 10 years. Um, Abbott had a big surge. Here's that green line. Abbott had that green line in 2016. Um, they had a big acquisition. I'll kind of get into that in the next slide, but I would say Abbott has been after that surge. Abbott has been able to kind of stay steady with a more positive incline past 8 years. So meanwhile, Boston is kind of on a downward trend slowly. But there's always potential for growth. So Abbott shows overall stronger liquidity, higher current and quick ratios. Let's see here. Yeah, Abbott had a big acquisition. Boston runs a little leaner, but it's due for a growth if you are looking for more of a growth potential as far as that size company. Abbott's a lot bigger and they're more established and they're a lot more stable, but Boston has the potential to seriously grow at a fast rate. Moving on to the activity ratios. Based on this past quarter reported, Boston beats the accounts receivable, the liquidity of receivables. So Boston gets their cash quicker, like I said earlier. Inventory turnover, Boston beats that as well. They're able to get inventory out and make sales, and they're very efficient with that. So, and then the asset turnover, Abbott barely beats Boston with that. But I would say activity wise, Boston definitely dominates. They're more efficient. How efficiently are they using? How are they churning out their sales with the stuff that they have? So, here are kind of the takeaways. Boston turns its inventory over a lot more. Boston also collects cash a little bit quicker as well. So Abbott does win on total asset turnover. But Abbott's extremely established and they're more diversified. They're able to sell more of their assets, and they're a much bigger company, so it's a lot easier for them. Kind of going into the profitability ratios, Abbott kind of dominates this entire across the board here, almost. Return on assets, they're about 1% higher than Boston. Return on equity, they're significantly higher. Same with profit margin. So the returns on Abbott is a much safer bet if you were to invest in this company than Boston. But Boston's only been around 30-40 years. Abbott's been around how long? 130 years. So Boston could very well be due. But if you look at the PE ratio, I did trailing to forward PE. And if you have a forward PE that's a little higher, that's a good thing. That means investors are looking upward for that company. So Boston had a pretty large dip as far as forward looking price earnings ratio from 53 to 28. It's not the most optimistic thing that investors can look at, but I mean, it's a good company. It's a very potential company. If you look at the profitability here, Abbott, the green line, as you can see, much more stable than Boston. It did decrease around 2017, but from there, it's been only upward pretty much. Boston had a huge spike, as you can see. I did kind of look into that. They had a big, number one, they had a big tax reform act that passed that year. They also had over $180 million one-time payment from another medical company. And, their products were doing pretty well that year as well. I think they were 9% in growth in sales. So pretty good year for them. Unfortunately, one-time stuff such as taxes and that one-time payment is a big cause. I kind of go through it here, but return on equity, assets, and profit, Abbott kind of is pretty good with that one. But like Boston's profitability is more volatile. There's more negative, but volatility could be a good thing if you're a risk averse investor. So, don't rule out Boston, I will say. Going into the coverage ratios, Abbott is very good with paying off their debt and handling whatever debt they have, whether it's interest or loans or anything. That they kill Boston in each of these. Times interest earned, they could pay their interest off 56 times over, is what that means. So they are They are pretty nice with handling and financing the debt that they have, but they've been around longer, so they know how to finance and what could look ahead as far as loans or anything that they need to owe, and are able to pay it off because they're such a big company. They make a lot more revenue, um, to be able to pay off whatever loans or creditors or anything that they get with interest. Boston, still not bad numbers. I mean, um, as long as it's on the lower side of one, or under half, like that's great. So, with the debt to assets, so still solid numbers. Just, Abbott's been around longer. Kind of the takeaways here. I kind of just covered these, but Abbott, a lot less debt. Abbott, their interest coverage is significantly higher. Um, but Abbott's more established, and Boston's still going. They still have the potential. They still have time to catch up, and they are catching up. Going into my valuation measures, I decided to do weighted average cost of capital. So, how much does it cost, I guess, to run their operations as far as interest goes? So, um, Boston's is a bit lesser, so less cost, and but that could be because they have a lower beta. Um, that's a big factor as to why they're a bit lower. Um, but both of these numbers are very close and pretty solid. But when you go to the discounted cash flows, I decided to do this as well. I decided to do valuation measures for discounted cash flows. But that's kind of projecting revenues or the value of the company, I don't know, 5-10 years from now, and then bringing it back to that current year. So, um, Abbott, much more negative number as far as current price, as well as Boston Scientific, but I would say both of these are significantly overvalued, right now, as you can see, versus current price, negative 44%. So, they're both pretty overvalued. But, yeah, that's kind of my valuation measures for Boston and Abbott. Summary: business as a whole, Abbott is much more diversified. Meanwhile, Boston has the potential to grow tremendously. Um, Profitability and solvency, Abbott absolutely crushes, higher pretty much everything, all across the board with that. Liquidity, both are great. Abbott is more established, so they're just a little bit better. But the fact that BSX or Boston is catching up pretty nicely. And then weighted average cost of capital, Boston's a little lower, probably because lower beta or lower debt. And they're just a little bit of a smaller company than Abbott. Um, and DCF, they're both extremely overvalued. Abbott is a more stable option for growth, but Boston could be due for a huge breakthrough. But I will say today, November 19th, I did check Yahoo Finance. They are about to acquire probably a med tech company called Exact Sciences, I believe. So keep on the lookout for Abbott if there's a bit of a uptick there. But here's my citations, and all the resources that I used. So, yeah, thank you.